Good afternoon, and welcome to your comprehensive precious metals market briefing. We are reporting live on what is shaping up to be the most historically significant day in the precious metals markets in decades. Silver has reached an all-time high, gold has shattered the $4,500 barrier, and we're witnessing what financial analysts are calling the hard asset supercycle of 2025. I'm bringing you an in-depth analysis of how we arrived at this moment, what it means for the global economy, and what comes next in 2026. Let's begin with the headline numbers, because they're extraordinary. As of today, silver is trading at $71.94 per troy ounce, trading relatively flat after reaching an all-time high of $72.70 earlier this month. That may sound like a small pullback, but the momentum that got us here is absolutely staggering. Over the past 30 days alone, silver has risen 34.85%. When you expand your view to the full calendar year, the numbers become almost surreal. Silver is up 141.58% compared to the same time last year, representing a 140% annual surge. To put that in perspective, gold, historically the dominant precious metal, has breached the psychological $4,500 per ounce barrier with a respectable 70% annual gain. That's a remarkable performance that would be front-page news in any other year. But 2025 has belonged to silver. The white metal has dramatically outperformed its yellow cousin, and the reasons for that outperformance are rooted in fundamental economic shifts that are reshaping global supply chains and industrial production. What makes silver's 2025 rally unique in modern market history is the distinction between why gold rises and why silver rises. Gold moves primarily on macroeconomic uncertainty, geopolitical tensions, and the search for stores of value. Gold is monetary, silver is different. Silver operates in a dual universe. It's precious like gold, but it's also an industrial commodity with irreplaceable applications in modern technology. That distinction became the central driver of 2025's transformation. The story begins with two converging megatrends that have created unprecedented demand for silver. First, the artificial intelligence infrastructure explosion. The build-out of data centers, semiconductor manufacturing, and computing hardware requires massive quantities of silver. These are not discretionary purchases. They are essential components of the global AI revolution. Second, the accelerating expansion of green energy across the world. Solar panels, renewable energy systems, wind technology integration, and related environmental infrastructure all require substantial quantities of silver in their manufacturing processes. Together, these two forces have created industrial demand for silver that is simply staggering. Here's where the market dynamics become critical. During the third quarter of 2025, the silver market experienced what traders call a physical squeeze. This is when supply becomes so constrained relative to demand that the market essentially seizes. Buyers couldn't find silver at any price point that satisfied their needs. Sellers held inventory off the market, anticipating higher prices. Supply chains experienced bottlenecks. By the time December arrived, silver had reached price levels that most analysts had considered impossible just 12 months earlier. The physical squeeze created what we are seeing today, a market fundamentally revalued by the collision of unlimited industrial demand meeting limited global supply. Now, whenever a market moves with this kind of velocity and magnitude, there are profound winners and equally profound losers. Let's talk about both sides of this equation, because understanding who benefits and who suffers reveals the true economic impact of silver's surge. The winners are straightforward: silver mining companies, investors who positioned early, and those who recognized the structural supply deficit before the broader market did. These constituencies have experienced life-changing profits. A miner who locked in production contracts at lower prices now sells at $72 per ounce. An investor who recognized the AI boom and green energy transition early in 2025 and accumulated silver positions has watched their portfolios multiply. These are significant wealth creation events, and they're real. But the casualties are equally real, and they're affecting actual economies and people right now. Industrial users of silver are facing what the market describes as a cost push crisis. Think about a solar panel manufacturer. Silver is an essential component of photovoltaic cells. When silver prices were $30 or $40 per ounce, silver represented a manageable portion of production costs. Today, at $71.94 per ounce, that cost structure has fundamentally changed. Companies involved in manufacturing photovoltaic cells have seen their input costs skyrocket. And the response has been predictable: slowdowns in project deployments, delays in expansions, and a desperate scramble for silver alternatives that may be inferior but more economically viable. Similarly, electronics manufacturers are facing pressure. Any technology that uses silver-based components or silver solder is experiencing margin compression that gets passed along in higher consumer prices or absorbed in lower corporate profits. The green energy transition that was supposed to accelerate is now facing an ironic headwind. The very commodities essential to its expansion have become so expensive that it's slowing the expansion. And then there are jewelry retailers. Traditional jewelry, silver jewelry, has long been an accessible luxury for middle-class consumers. A nice silver bracelet, ring, or necklace was a purchase that ordinary people could make for themselves or give as gifts. That market has essentially frozen. Retailers have been forced to raise prices to levels that have priced out the middle-class consumer entirely. The 2025 holiday season, which concluded just hours ago, has seen a sharp decline in discretionary silver jewelry sales. People are choosing alternatives or simply not purchasing at all. That's an economic consequence rippling through retail and manufacturing networks. The short-term market outlook is becoming clearer as we head into 2026. Trading economics and market analysts expect a technical correction in the near term. Here's why. Traders who entered positions early in 2025, who accumulated silver when prices were lower, are now looking to lock in their historic profits. A trader who bought at 30 per ounce and is selling at $72 is capturing a 140% return. That's generational wealth. As these early bird traders exit positions to realize gains, they create selling pressure that typically drives prices downward. Trading Economics estimates that silver could trade at $67.33 by the end of this quarter, suggesting a pullback from the $72 level. That would represent a roughly 6% decline from current prices. But here's the critical distinction that separates this moment from a typical speculative bubble. The structural factors driving the surge remain intact. The AI infrastructure boom is not ending in 2026. The green energy expansion is not slowing. If anything, these trends are accelerating. Industrial demand for silver from these sectors will continue. The supply deficit that created the physical squeeze in Q3 is not being resolved. New silver supply can't be magically created overnight. Mines take years to develop and bring online. This is why analysts are already projecting that any technical correction will be temporary. Once traders lock in their early profits and exit their positions, structural demand will reassert itself. The broader context here is that 2025 has fundamentally rewritten how global markets value hard assets. Silver, which was long dismissed as the poor man's gold and treated as a secondary precious metal, has emerged as an industrial powerhouse with price dynamics driven by genuine scarcity. When you have unlimited demand from AI infrastructure and green energy expansion, meeting limited supply, the economics are straightforward. Prices rise until demand matches available supply. For investors, this presents opportunity in 2026. Those who sold at the peak can look for re-entry points during technical corrections. Those who didn't participate can accumulate during pullbacks, betting on the structural thesis that industrial demand will drive prices toward $80 to $90 by year-end. For industrial users, manufacturers of solar panels, electronics, and related technologies, 2025 was a year of painful adjustment. They're faced with difficult choices: absorb higher input costs and accept lower margins, raise prices to consumers, and risk demand destruction, or pursue inferior alternatives and compromise product quality. None of those are good options, which is why you're seeing the slowdown in certain sectors, despite the strong underlying economic rationale for green energy and AI expansion. For jewelry consumers and retailers, the market has essentially repriced silver out of the middle-class luxury category. Whether that proves temporary or permanent depends on whether prices stabilize or continue climbing. If silver settles in the $70 to $80 range, jewelry becomes scarcer but not entirely inaccessible. If it continues toward $90, it may remain a luxury item primarily for those with significant disposable income. As we move into 2026, the precious metals market will continue to be shaped by three fundamental forces: the trajectory of the AI build-out, the pace of green energy expansion, and the pace of new silver supply coming online. Of those three, two are accelerating and one is in a long lag cycle. That asymmetry is what's likely to keep upward pressure on prices, despite near-term technical corrections. We're witnessing a genuine structural revaluation of commodities essential to the future economy. Silver, gold, and precious metals are not moving because of speculation alone, though speculation certainly amplifies the moves. They're moving because the physical economy is reallocating capital and resources toward AI infrastructure and green energy. And those transitions require materials that are becoming genuinely scarce. That's the story beneath the headlines, and it's the story that will likely continue throughout 2026 and beyond.